Hi everyone, how's everyone doing? I'm Dale Pinkert, methodologies and outlooks in the market with you. Hope everyone's doing okay. We have the continuation of the dog days of summer with lackluster moves, thin volume. Expect this to continue until after Labor Day when the hedgies get back from the Hamptons and Europeans get back from Ibiza or wherever people are taking their summer vacations. When the kids go back to school, the markets will be in full swing again. So I do expect volume to increase again after Labor Day. This is definitely seasonally a slow period in the market. Good time for education and training, not as good of a time for trading, although there's still some trading possibilities out there that we're taking advantage of. And let's start off, as we usually do, with a basket of what we trade, and that would be the dollar index here. So we've held at this 80.5 level, and again, going back to the high that we had in July, there was massive divergence, glaring divergence. We talked about that when it was happening, that we had at least a correction due in the dollar. The dollar is not as good of a short here as it was when the divergence was occurring, and wasn't easy to sit through this type of action here on spiking action on news. But to me, it looks like they most likely want to clean out the longs under the 81.50 handle here. I talked about over Labor Day is September 3rd, I believe, G, here in the States. First weekend in September, so a couple weeks away. This has been a good environment for you to get the fundamentals down and be ready when markets begin to trend again. In fact, if my scenario preferred count is correct, then there's one more decline to clean out the bulls under 81.50. Talked about in August 15th low, which comes in on Wednesday. I'm off to Chicago on Wednesday, and they have the stress test for the European banks. So perhaps they're going to try and clean out the longs going into the stress test. Perhaps they make the stress test not look as bad as everyone thinks they're going to be with all the problems in Spain and Italy and the European banking system. So Wednesday is going to be newsworthy with the results of the stress test. But chart-wise, it looks to me like we're still in some type of corrective pattern that could take this market back down towards an 81 handle, possibly 80.50. And then at this point, I'll become interested in buying the dollar again, viewing this as still an ongoing bull market, and this is strictly corrective action. And then again, if the inverse should occur and we had some type of pop up to new highs, I don't expect a lot of follow through if that happens from here, because that would set up a third drive, something I teach quite a bit, and most likely would even set up a second divergence under the late May, early June high. So from here, it looks lower at 80.50 for a longer term dollar buy. And should we get some type of spike action back to the highs, I'd be looking for topping action there. So if you could give me a Y, that you understand the analysis here, that the two major areas are going to be potentially down to 81, 80.50, and should we get back up towards these highs before going down here, could set up another selling opportunity in the dollar. Buying opportunity here, selling opportunity back up around the highs. Give me a Y if you understand that. Thank you. Good. Any other opinions in here in the room that you'd like to share during this webinar? Okay. So let's take a look at one of the linchpins, of course, is the S&P market. And again, you know, you have a lot of bearishness now still. But this recent high has done what? What kind of high is this that we have in the S&Ps up in here, based upon the RSI? Is that a divergent high, or is that a confirmed high? And Sal, I think we talked about this back in June, a recovery into the August time frame. I thought maybe late August. That I don't see it as divergence here. I see it as it's not a real strong reading, but the new high did confirm up here last week. So it's a confirmed high, so even if we get a little pullback here, there's probably more to it. I've seen some wave counts at 1410 could be significant because we're at a fib level on the weekly, on the daily from the high, right around a little bit above the 76.4 and closer to 78.6, one more up. Right, so that's what the RSI is saying too, one more up. So that would tie in with one more down in the dollar index, down towards that 81, 80.50 level. And then the bears may have their September, except a lot of people are looking for September to be a negative period. But, you know, there were a lot of people looking for a sell in May, and that worked too. So we're not going to poo-poo it just because September is well known to be seasonally a negative month for risk. So we're going to be looking for divergences up maybe around the 1410, 1420 level up here as it approaches the April highs. Let's take a look at the weekly. The most interesting action, why is it? I've also heard that during the presidential cycle that a sell-off in September is kind of indicative of a change of administration, so take it down into September. As far as why it's a seasonal sell, I can't explain why cycles happen. I just need to recognize that they do. Could be that we're going to be wrapping up a third quarter at the end of September, so that could be the case too. So here we are, right back at the April highs. Be my guess that they'd want to squeeze every last short, take out these highs first before we get some type of sell-off. And even talked about the outside shot of 1430 to 1450 before that happened into late August. So that's in gear. I think one of the major developments that we've seen happen, and it's something that I've been sharing on FX Street for the last 2 or 3 months, is that I felt that the treasuries were a very crowded trade. This is your weekly. And we had a fairly dramatic sell-off in the TLT, which is an ETF based on the 20-year treasury. It used to be the Lehman Index, but we know where they are. They're not around anymore, so now it's Barclays. And talked about that at new highs we were diverging, similar to what the dollar was doing. So it's going to be interesting to see if the dollar does begin to rally again, how much the bonds have in it. I think it's pretty negative that this sell-off came all the way back down to major support. If you're following me on Twitter, I talked about taking half off down here on this day and moving your stops to BE. Because if we start to take out this 124 level, it's a game changer in bonds because it would measure all the way back down to 116. One of the surprises to me is that we haven't had more of a lift in U.S. dollar yen, which is used in the carry trade and normally trades. Yes, correct, Guy. And normally you'd have them moving inversely, and we've had a very muted rally in the USD Japanese yen. I'll show that when we get to the individuals. But I think this could be a game changer, something that has been an ongoing bull market for decades that's starting to show its first crack. And I believe at first they'll spin it as growth, housing recovery, etc., the kind of things that we're hearing. But this definitely is not a positive for the risk off trade anymore. It doesn't look to be a haven to me anymore, and should imply a decent rally in US dollar yen, as they have moved inversely unless that correlation is completely breaking down. So there you have that. Let's take a look at the energy market. Same thing has happened in energy as in S&Ps. We've had very little pullback, but it's been an awful long run. It's not the same type of compelling buy that it was here when we had divergence. Again, something we talked about back in late June was crude was making new lows, RSI diverging for the second time, and it really never looked back. So here we are pressing the 95 level. We're probably approaching some type of fib retracement from the big sell-off we had in May. Of course, unlike the S&Ps, it's not back at new highs. So of all the asset classes, actually equities has been stronger, including people that are gold bugs. The best recovery trade during June were the stock indexes. That's not gold. That's not either. That's feeder cattle. Commodity inflation, food inflation. You would have expected more out of the precious metals. All the action has been in the agricultural commodities. So here's gold, still trying to carve out something in here. Putting in higher lows. Take a look at copper. Has been a fairly anemic recovery. And we call copper, up until now, we call copper the metal. I know what the issue is now. It's the end date. Okay, there's the S&Ps. Let's take another look at the gold. I knew that picture didn't look right. I want to point out something that the bears can still hang their hat on in gold. And I know people that have heard my webinars before are aware of it. Hello, Carlos. What kind of low was this in May? Unlike crude. Anyone know what kind of low this was based upon the RSI reading? What have I renamed the RSI from relative strength index to what? R meaning real, S meaning simple, I meaning implicator, right? So it was a confirmed low, Gangster. Okay, there was no divergence in May. See that? RSI confirmed this low, and this to me still looks like it could be corrective. So if we're going to get that dollar rally, perhaps we get this break in gold, take out the bulls that have been accumulating for the last couple months. Copper's been very anemic on its recovery, which is a negative sign economically. It tells me that China has a lot more work to do on the easing front. We say copper has a PhD in economics, and all bull markets are roofed in copper, and copper really had an anemic recovery. And this is saying that there's still problems with global demand, problems with China, and copper looks exceptionally weak down here. Perhaps new lows we would diverge. Maybe we're going to set up some type of spiking action, but it looks like 320 is within earshot for that to occur. So with that said, on the outside markets, let's go to our pairs. Starting off with the hourly. Everyone see this chart? Let me just check something out here. Let's try it now. Okay. Here we go. USD CAD has been under some pressure with this recovery in S&Ps and with what it correlates with in the crude market, starting to give some signs of a potential low. I still think that there's a possibility that we retest here, but I'm starting to look for reasons and reversals in USD CAD based upon what's happening here. We've had two drives to a bottom. Perhaps we have one more shot down here if the dollar index sells off. On the 4-hour time frame, we're diverging at new lows as well. So I'm looking at one more low and possibly probing the long side of USD CAD. Can everyone see the divergence here on the 4-hour? This was your momentum low, and we made new price lows with a nice reading above 30. That's one of my rules. Same thing happened here on this spike. And it's my assumption that if we got one more break back down here, 40, 50 pips lower, that would happen again here. So looking for reasons to get long USD CAD, because crude could also be due for some type of correction. We've rallied close to $18 off the June lows, and why not give back 9, pull back towards that $80 level or so. That would argue for a nice rally in Canada, so I'm looking for one more divergence. The 3 drive formation would be something I'd be paying attention to. Everyone see this divergence here? Starting to get a look of a falling wedge to me. Here's the picture. What kind of formation is that? Anyone know what kind of formation that is, where you have a down channel and they begin to converge, the two downtrend lines? What is it, Keith? What do you call it? Jack, you know. Market timer knows that's correct. It's a falling wedge, and what type of formation is that? Continuation or reversal? What does it imply? Right, it's a reversal formation. Wedges are reversal formations. And how much of this move by the textbook would the wedge retrace should the breakout be valid? 50%, 38.3, 61.8. What's the rule? It's 100%, my friends. Wedges retrace 100% of the move. So we could be talking about, when we come out of here and it becomes valid, a move back up towards the 102 level. So that's my take on it. I'm going to be looking for reasons to do something there. Pound is diverging, pound dollar. And the pound would be my preferred short over euro at this time, because I still think EG has another move left to the upside here. So if EG is in an uptrend, what's your preferred long between euro and pound? When EG is heading up, what's the message? when EG is heading down. What was going on when EG was doing this? Euro was leading the way down, right? When EG bottomed, Euro led the way up. So if I want to play the long side of the dollar when this is happening, I prefer a short in the pound over the Euro. Give me a Y if you understand the analysis of how you use Euro pound to give you a preferred long or short between pound dollar and Euro USD. The example being back here when Euro was making a new low. Euro pound was making a new low. That was here. And then when Euro made a new low, we put in a higher low here. We didn't confirm. So what I'd be looking for to give me an indication that the dollar correction is running out of conviction and momentum would be a scenario where Euro made a new high for the rally and EG fails to do so. And that could happen. We could have a new recovery high in Euros much closer to making new highs here than EG is, right? So we're going to know it's going to be right to short Euro when Euro pound begins to not confirm the new high in Euro. Give me a Y if you understand that, and you'll be prepared and watching that for a reason to start getting bullish a dollar and bearish Euro. Who's learned something new today? Give me a Y if you have, and tell me what it is. So it's my contention that they still want to take some more of the bears out in the Euro before we get down towards some of the bears targets, 116, parity, whatever the, Armageddon targets are, that they still want to take out some of the bears. And there's some stops, buy stops here. And I really wouldn't be completely surprised if before it's over, we take out the shorts from up in here as well, and here, and then start heading back down in earnest. So my take is not, and I've been talking about not being too bearish the Euro for a while, and the reason is because of the signal I got in EG, which still is not being negated. There still could be one more push up in EG. Here's a market that I continue to accumulate. There's basically because it's out of favor. If I'm right about treasuries, I've shown this many times, yen going down while treasuries are going up in price, down in yield. The low in the yen was way back in October, and treasuries have made higher highs. If you remember back here, everyone loved the yen. They were talking about targets at 92, 95. Now all I hear on the street is, yeah, most likely, we'll take out 77.5. I really don't see much bullishness or enthusiasm for it. And also, it's been so quiet. Here's your daily. You've had this big break in the dollar, big recovery, and a lot of people are saying it's a bear flag, and I could see how that's a possibility that this is a bear flag. But it's so quiet and range bound that there's an old Wall Street adage, and it is never sell a sleeping market. Never sell a sleeping market. And if this isn't watching paint dry right now in the yen, I've never seen paint dry. So, big ranges are 20, 30 pips. Also, if the Japanese do want to intervene to protect all the money that they invested back here and back here on the way down to stabilize it, one of the best times for intervention to have potency is during thin, illiquid markets, which is, again, between now and Labor Day. So we'll see what comes to pass on that. We've already talked about EG. Think that there's still possibility for another rally back. This could have been A, B, C for a B wave, and one more up. Aussie had a nice top in here. Well, I talked about 106 in this range, so we've achieved it. There is some divergence. I just don't want to sell the strength, okay? If I think the euro still has some more upside, I'm not willing to short Aussie. If I'm wrong and the S&Ps are putting in a significant high here, once I believe that's the case, then because Aussie is so tightly correlated with the S&P, I'll be more interested in the short side of the Aussie. But not believing the S&Ps have done it yet, I reserve judgment. If I start to get some negative signals to confirm this high, just like W.D. Gann said, if you don't learn how to change your mind, you won't have any change left. I'll change my mind. Swiss, to me, the inverse of what you have in euro. Still think that we could make some more moves to the downside, possibly back towards this 95, 96, wave 4 of lesser degree. So in quick review, it's my preferred scenario that the dollar index heads down under the 81 handle, that we have a bit more left on the upside in risk. I'd be very cautious in gold because of the confirmed low. I'd be looking for a correction in the crude oil market and reasons to buy USD CAD. For now, my preferred short between the pound and the dollar is pound dollar, preferred long euro USD. Still looking to accumulate US dollar yen. It's a sleeper trade. No one's paying attention to it. And Aussie and Kiwi, I'm tempted to top pick it, but I'm going to wait till I have more confirmation that this S&P high is in, and I still think that they have to take out the April highs before I get interested in taking that type of position. Okay? What's your most valuable currency? Mine is time. Mine is time, geek. So I appreciate you spending your most precious currency with me this morning. I hope I'm adding value to your experience here with my friends at FX Street. I'll be out of town for a week, so I'll probably see you next Wednesday in the premium or the following Thursday. Good hunting in the meantime, and thanks for your attention. And remember, don't just count your pips, count your blessings. So thank you, everybody. You're very welcome, Mish. You too. I'll be in Chicago. Thank you, Vicki. Adinda, everybody. Good luck to you this week. You're welcome, Victoria.